Hi everyone, I hope you guys are doing good. It's been a while. I have posted something, so I'm back again this year, the beginning of new year, with another exciting video for all of you. Now, as you all know, I have been posting a lot of content around payments, which I will continue anyways. But at the same time, some of you also reached out and requested for some of the content around other areas, for example, capital markets, investment banking, etc. So I thought maybe in this year I should start a separate series for this. Now, in this video, we are going to cover a little bit about the basics of investment banking. We'll touch base on various different domains which are a part of banking and financial services overall. And then going forwards, as and how I see the response from all of you, I'll try to make more content on specific individual areas. And needless to say, these areas would be explained in a way that anyone can understand that, particularly people who are working in financial services projects, especially in the IT sector. Oh, and very important to mention, if you haven't checked out my website, easyfight.com, make sure you do check it out. The link is there in the description. On this website, I am trying to publish a lot of content. For instance, if you want access to these PPTs that I make in these videos, you can get these access to these PPTs on my website. All that you have to do is you have to subscribe to my channel and also join the channel as a member. The content would be made exclusively available to the members who join this channel. And not just that, there are various levels of membership. You can choose the membership according to your needs. So without much ado, let's get started. Now, as you can see here on this slide, I have tried to depict some of the domains, rather most of the important core domains under the banking and financial services umbrella. It's a huge umbrella, and there are a lot of services that you can see are a part of this umbrella. Typically, when you are in a consulting firm, for instance, an IT consulting firm, they would have their verticals set up accordingly, right? So there will be a big vertical like a banking and financial services vertical, and there would be different domains that will be a part of this vertical. And again, this could vary from company to company, but by and large, majority of these things that you see on the screen here would be falling under the umbrella of banking and financial services. Now, if you see there are certain domains that I've listed out there, and payments, of course, is the second domain that you can see. And I think majority of you who subscribe to my channel and who watch my videos regularly understand the payments domain and what it is. But then there are certain other domains. For example, there is capital markets, there is insurance, there is core banking, real estate, consumer finance, where you do all of your lending for retail customers. So all of these are also domain which are a part of the bigger umbrella, which is your banking and financial services umbrella. Now, in this series, what we will try to do is we'll try to slowly and gradually move towards understanding capital markets. And this is very helpful for people, like I said, if you are working as a QA, or if you are working as a production support guy, or you are working as a developer who is working into building applications and platforms, data platforms in capital markets, then I think this content would be really, really useful for you. Because like I said, we are trying to cover this from an IT perspective as well. And of course, as and when there is a need, we'll be talking about different data aspects that are important around these domains, right? So we'll be zooming into capital markets. Now, one thing that I really wanted to emphasize upon is that some of these domains are overlapping. Now, for example, if you see here, capital markets and payments, you may find it as overlapping at times. What it means is when you are investing in, say, capital markets, obviously the fund movement happens through some payment instruments, some payment platforms, right? And therefore, it's not like all of these domains are independent domains, right? There are various situations when these domains would be overlapping with each other. And again, core banking can probably be integrated with insurance to a certain extent. There would be overlapping aspects between the two. And sometimes what you would also see is that certain domains are kind of overlapping, and they have a bigger, sort of focus amongst the two. So for example, when you're dealing with payments and capital markets, there might be a situation where payments is sort of more emphasized. I'm just again talking about certain projects, certain environments, certain situations where sometimes you may be talking about some payment instruments. For example, there could be a direct debit that you'll be talking about. For example, there could be a bank account transfer that you could be talking about. But then the underlying things, the underlying domain about which these payment instruments would be moving around would be capital markets. And again, you have to be aware, be informed, be safe, and that is the reason why we invest, right? So particularly when we talk about investment banking, the reason why we invest our money is because obviously we all want our money to grow, right? And we also want to beat inflation. As you all know, in whichever part of the world you are, we are dealing with high rates of inflation everywhere, right? We also want to save taxes. So, come financial year end, and then everybody would be looking for some sort of investments. People who are in India, they might be looking at some investments in Section 80C, for example, to save some income tax. There could also be some life events that you may be looking to invest for. For example, you may be looking to get married, say 5 years, 10 years down the line, and you want to save some money for that. You also want to make sure that your money grows. You may be looking for doing a higher education course, maybe a degree from a foreign university, and therefore you would want to invest into that. And you're also saving for your retirement, right? So there are a lot of things that a lot of funds in the market today that you can actually invest your money in, and that could be used for your retirements. And the whole theory over here is that the reason of why we invest and the amount of money that we get back outside of our capital is because we are willing to lend our money to someone, right? That someone could be a person, that someone could be a corporation. Typically, it's a corporation, not a person. But the idea here is that we lend our money to someone and he gives us the capital and some return back on our invested capital, because money generates interest. Now, what degree of interest you get back, what degree of gains you get back, depends upon the kind of instruments that you're investing in. Certain instruments are very high risk instruments, certain instruments are low risk instruments. And so it all depends on your risk appetite. Much of these things, I think, are not something that we all don't understand, right? I mean, we all invest in our mutual funds, we all buy insurance policies. So certain things, we already know, but it's just that when it comes to understanding, from using this sort of knowledge in your projects, in your jobs, in your careers, it's kind of sometimes important to take a step back and understand, why did I make an investment into this fund? Why did I buy a life insurance policy here? Why did I invest my money into shares? What do I understand about dividends and things like that, right? So it's kind of like same thing that you have been seeing more often in your daily life, but then sometimes you don't realize what these things are. Now, typically when it comes to investment banking, we always say that there are two sides to an investment banking arrangement. One of the sides is called as the buying side, and the other side is called as the selling side, as you can see on the screen here. Now, what do we mean by a buying side and a selling side? So simple as the name says, somebody is buying something and somebody is selling something, right? Now, these are all like two sides of the same coin. When you relate to an example in payments, it's like a debit and credit transaction, right? So somebody is debited, which means that somebody else is credited, right? So same thing, somebody buys something because somebody has sold something. Now, who is this person and why is he buying it, and who is the other person on the other side and why is he selling it, is what we are going to understand in this slide. Now, buying side is basically when you buy some financial assets. Why do you buy financial assets? Because you would want to invest into these assets, because you have a trust on these assets that these assets will give you a good return in future. So you buy securities, for example, which could be in the form of a share, which could be in the form of a fixed income bond, or things like that. And you understand that these securities are a good investment from a future perspective. Maybe these securities are underpriced right now, so you are getting it at a very good price, and therefore you know that with time, 6 months, 1 year, 2 years down the line, the price is going to substantially increase, and therefore you invest that money. Now, we as investors would invest into that money, right? So we would go to a mutual fund company and say to that mutual fund company that I have got X amount of money that I would like to invest with you annually or maybe monthly, and in return, what is it that I can get, right? And you would have always heard this cliche line that funds are subjected to market risk, your investments are subjected to market risk, you may even have a risk of losing your capital, etc. So it means that nobody can guarantee you that you will get X amount of money in return, right? Because we are living in very, very turbulent times anyways, and most of these things in money markets or capital markets, nobody knows how the market movement would be, right? There could be some global phenomena that happens, some geographical phenomena that happens, some war happens between the two countries, and then the whole world we'll see the repercussions of that in terms of high inflation rates, etc. So basically what I'm trying to say is that you cannot predict, right? You can only sort of guesstimate. There are a lot of theories, there are a lot of tools and techniques with which you may want to predict, but then nobody knows how the future is going to be. On the selling side, there is somebody who is selling these financial assets. Now, who are these people? These are like brokerage firms, banks, who would be creating the funds and their securities, and they would be selling them, right? So they would be promoting these securities. They would be getting in touch with the asset managers, the fund managers, and saying that, hey, I've got these securities, why don't you invest your money with us, buy these securities, and in return they get fees and commissions, right? So the more they sell, the higher the number of the commissions that they make. So that's basically essentially what the whole summary is about buying side and the selling side. I've tried to show all of this in the form of a diagram so that you understand this flow well, right? So the whole idea is that we want to make the money that we have earned, our hard-earned money, in the form of the businesses that we do or in the form of the jobs that we do. We want to make sure that whatever amount of money that we are able to save, it's not just lying as is, because we know that inflation is going to beat you in the longer run if you don't plan well, right? If you don't plan your savings, your money to be invested in a place, in a platform, in a security where you get higher returns than what the inflation is, then you are essentially losing your money in the longer run. That's the whole idea. Now, if you see here, there are certain players that are there in the diagram. You can see there are investors sitting on the left-hand side. On the top, there are the brokerage firms that we already talked about, the fund management institutions or the asset management firms sitting at the bottom there. And on the right-hand side, you have the corporate houses or the governments. Now, who talks to whom and why? Right? That's the whole essence of what we have to understand in this diagram, right? So I, as an investor, now the investors here that you see on the left hand side, they could be anyone. They could be people like you and me, or they could be some big corporates as well, right? So there could be some high net worth individuals as well. There could be millionaires, billionaires who may have a lot of money to invest in. You could be ordinary people like you and me also, who would want to invest your hard-earned money. So we would go to a fund management institution, for example, a mutual fund company, and say that we would like to invest our money with you. Now, the mutual fund institution will take that money and will invest that money on our behalf with certain other entities. Now, who are these entities? There could be government houses, they could be corporate houses or governments. And what they will do is they will buy some securities from these corporate houses in the form of bonds, in the form of corporate bonds. If you don't understand corporate bonds, don't worry about it. And maybe at some point in time, we will be talking about these things. Maybe when we talk about, say, fixed income in a little bit more detail, then we can talk about these things. There could be some shares. You may be willing to buy some shares from some company. Maybe you would want to buy Google shares, Microsoft shares. In India, maybe you would want to buy Reliance shares, Adani shares. And when you buy these with the hope, that these are trusted corporations, these are trusted companies, and you kind of anticipate that 3 years, 5 years down the line, you would get some money back. So this is the theory of the asset manager. He will take that, and what he will do is, when he buys these, he will give the money to these corporate houses and say that, okay, you have given me a security of your company, an equity of your company, and in return, I give you the value worth this equity. So the corporate houses will get this money because they would want to maybe expand their businesses. Maybe they would want to open another plant in some other geography, in some other state, and therefore they would want to have more money, right? They would want to generate more funds. So therefore, they would be selling the securities. Similarly, governments as well. They would want to do some welfare projects for the people, and they would want to raise some money. Where are they going to get this money from, right? So the idea is that we take this money from the market, we invest it, and we give some return back to the investment firms. So, and if you see here, right, everybody is making money. So we make money as investors because we are giving this money. The fund management will make money because obviously he's going to generate some fees and he will be charging you. So let's say if he says that he will give you X amount of returns, then 1% or 2% of that return would be his income. So that's why he's sitting over there at the bottom, and then the corporate houses are also getting the money because they would want to implement their projects. At the top, the brokerage firms, which we already talked about, these are the brokerage firms that would also be talking to these corporate houses and saying that, hey, you know what, we can be acting as a middleman for you. And that's why we call it them as brokerage firms. So they act as brokers, and they say, to these corporate houses that, why don't you allow us to sell the security? So we will provide you the capital that you need, and they will be buying the securities from them. They would be probably helping them, rather, I would say, helping them to sell the securities to these fund managers. So if you see here, like, it's kind of like a cycle that works, and eventually the idea is that economy grows and everybody makes money out of it. So I've given some reference links as well. Let me just quickly go through these reference links and why and how you should approach this. And I'm assuming that many of you are new to this area, right? So people who understand these things, I think you may have already seen this before, but it's basically for the beginners. So, right, investopedia.com is a very, very popular site when you're talking about financial markets, and we want to understand financial markets, then that's one of your go-to places. You can also visit some websites of consulting firms like McKinsey, Deloitte, KPMG, because they publish a lot of useful content in the form of case studies, in the form of blogs that you should be going through. And this will also help you to understand the latest trends that are happening today, right? So when you have a sort of a gradually built platform of knowledge, and we understand these instruments well, then I think you can also start visiting these websites. IT consulting websites are very good, and I think are very, very underrated source of knowledge. I think many of us are working in these companies, and I don't know how often do we go to the company of our own the website of our own company and check out what is the content that they are trying to publish. But trust me, I have seen that some of the companies, for example, there could be an Infosys, there could be a TCS, they publish some brilliant blogs, and posts on their websites. A lot of experienced people who have spent 20-25 years, decades of experience into IT consulting, particularly in financial markets, and they publish some marvelous content. So make sure you do hit these websites every now and then and check out these blogs and posts. Financial news websites like, for example, FT Times, Money Control, if you are in India, very, very popular. I think many of you who are investing in shares anyways go to Money Control every morning to check how the market fluctuation is. So there is kind of familiarity on these websites, but change your perspective, right? Change your perspective. There are a lot of, so to speak, boring things there on these websites. For example, opinions. For example, there is some management firm, asset management firm who has published their opinion about how the macroeconomic or the microeconomic trends would be down the line. So go through those things, develop your own perspective is very, very important, is what I'm trying to say. And last but not the least, certifications. If you are looking to build a career into financial markets, CFA is a no-brainer. Everybody knows about it. FRM, particularly for people who want to build their careers into financial risks, very, very important certification. And if you don't want to trouble with going through these certifications and massive amount of hard work for years, because trust me, these certifications are not easy. You have to really, really work hard to achieve them. You can go with something very, very simple to begin with, which is like an NCFM certification. So particularly for people who are based out of India, the National Stock Exchange or the NSE publishes some very good content on their website, and they have also doled out some of these certifications to bring in more awareness to people about financial markets in general. So make sure you do check out these certifications if you are interested. So I hope you found this video useful. You would have got some knowledge about capital markets. You would have got some knowledge about financial markets, investment banking. And if you did, please do make sure that you give it a big thumbs up and share this video with your friends and colleagues who can benefit out of it. Make sure to subscribe my channel because I keep posting such content on this channel regularly. The idea going forwards is that we talk about a lot of things outside of payments, outside of general things that we have been talking about, data, something that is of more intrinsic value to all of us, right? So something that kind of affects all of us, be it investments, be it a little bit of awareness about money, and of course, anything in general. So with that, I will take your leave and I will see you back once again in another exciting video very soon. Thank you.